Adem, you're unmuted.
Hi, Dale. You able to hear me?
Ah, I got you. Oh,
There we
how
go.
are you?
I'm doing good. How are you doing? I hope you guys had a good holiday.
Yeah, well, good holiday. Just watching football and COVID and troop buildups and markets broken.
Right? Yeah.
Yeah, my computer crashed when the market did, so I don't
Oof.
know what that means.
Well, you're surviving, so
Yeah,
can't do any better than that.
I didn't clean
Dale,
up on the short
you should
side.
have known better. Don't confuse correlation with causation.
Yeah, I know. Well, I tell you what, I'll just pick up the phone next time and get my orders in. Thanks, Steve. So I'm really interested in them and what's on your radar. I know that last time you were on, that you had some contrarian type positions that you were putting on. How they working out? And are you going to share your screen here?
Yeah. Let's see. Are you
It's
able
that
to see
green
it?
share screen. There we go. Okay, there you are.
Okay, great.
Yeah.
Yeah.
Oh no. That's Al Pacino. Where are you? No, that's you. Al Pacino. Do you know who he is? Adem, are you there?
No. Yeah, sorry. I'm trying to get the share screen going. Are you able to see my?
I see your Twitter.
Oh, okay. Well, perfect. We got it going. All right.
It was a joke. That's Al Pacino, not Adem.
Oh, sorry. I didn't hear you say that. That's
you look like a rock star. So what are you looking at, buddy?
All right. Well, yeah. Last we spoke, you and I think we're in agreement that we thought 2022 we were positioning for slower growth, Fed tightening, strong dollar.
Yeah.
I still think yields are going lower. I think there's a pendulum right now of between inflation and deflation. The worst of the inflation I think we saw because of the supply side issues. I mean, we saw the government do an aggressive stimulus in 2020, creating artificial demand, and at a time when we saw supply sides getting wrecked because of COVID, and obviously that pushed prices higher. And 2021 was a year full of noise, but I think one of the most important things we saw in that year was the return of China's aggressive surpluses. And when China runs a current account surplus, that consequently it means on the other end someone's running a deficit. And since we're seeing the Eurozone and Germany run huge surpluses while running their own QE, I guess it looks like the US is stuck continuously funding those bond credit demands. And I think we're going to see investors continuously willingly fund the US because there is a huge savings glut, as you and I have talked about in the past. Since the 1980s, there's been the rich are getting richer. Obviously, we've seen a huge asset bubble, and the rich can't put their money under a mattress. Correct? I mean, everybody knows this at this point. As the rich get richer, as corporations get more cash flow, they have to put that money somewhere. It's not like an everyday person where they can stash it. Actually, there's a lot of studies that have shown that the savings glut of the top 5% has fueled the debt trap for the other bottom 95%, which makes sense. As the banks get more cash, more supply, the yields have continuously dropped. The interest rates have declined while they compete with each other to get that money out the door. Well, since this year, we've seen banks, as I pull up this chart, the overnight reverse repo. This is something I think a lot of market has completely forgotten. This has kind of been a soft tapering.
Thanks for reminding us.
Yeah, to me, it's amazing that this shows perfectly what's happened in 2020 and why we're not seeing any big growth or why any tightening by the Fed is going to be, in my opinion, nullified. It's the QE has been officially more or less nullified. This is each night banks and money market funds and basically the financial institution are having to park $1.6 trillion every single day in overnight repo to get collateral back. from the glut of cash they have. So for those that don't know about QE, in summary, QE is when the Fed sucks high-yielding assets, meaning bonds, out of the system, which people want, financial institutions want. The wealthy consider bonds as money, but they're sucking it onto their balance sheet, and instead they're giving banks zero-yielding assets, known as cash, because cash doesn't yield anything on its own. The theory was, when QE began, oh, hey, let's get banks loaded up with reserves and deposits and cash, et cetera, all the same thing, basically, so that they'll lend out. But the thing is, banks only lend when the economy is healthy. It's not just the demand side. So for the past 40 years, supply of for the last 10 years, supply of money has not been the problem. So the Fed keeps pumping more money into the system, but they act like that's the problem. That's not the problem. Getting money has never been easier for the past 10 years. It's the demand for the money has eroded as leverage has increased, as marginal investment has decreased, as wages have decreased. And we've seen that over the last 40 years. And I think that the Fed right now, they're just pushing on string. And we're seeing banks kind of with the reverse repo. They're like, hey, like this chart shows, $1.6 trillion every single day the financial institution is sending back to the Fed in a soft tapering. It's almost like it's nullified the entire QE that's gone on the last year and a half. So in my opinion, that's already a soft taper.
So if this was already a soft taper, and now they're in a hard taper on top of it, right?
So now, because of so now the Fed's in a box because, like in the 1970s, we saw the wage price. Sorry, everybody talks about like great inflation, occurring like the 70s, but it's a totally different dynamic. Unions were never stronger in the 1970s. They were fighting for the wage. It caused the wage price Keynesian cycle.
Right.
It showed how the Phillips curve was a complete mockery of economics and how it imploded with that. Like, oh, the lower unemployment means you're going to have higher inflation, which obviously in the 70s when unemployment spiked and then inflation spiked at the same time, it showed that correlation is ridiculous. Not to mention, the biggest part of the 1970s was the supply side with the Saudi Arabia oil embargoes. Exactly. And that was what really hurt people. But in this day and age, we've seen such a concentration. There has never, so some research I did.
Ravi Batra wrote about it 30 years ago in 1990. The wealth disparity was going to lead to a depression in 1990. So the Fed has, Batra was early, but is that what you're saying is because of this wealth disparity?
Yes.
We're going to have problems.
There's actually a great book called Capitalizing on Crisis, and it's written by Greta, I believe.
By government.
Greta Krippner, and she basically, her thesis went undernoticed, but it's important because she talks about how the financialization. So after World War II, there was a boom, and the government, the Treasury, had made a lot of entitlement promises. But the thing is, you can't escape the law of diminishing returns. We're seeing it everywhere. Total factor productivity, TFP, is the most important growth metric everyone should be looking at. And China, since the 2000s, was the main source of TFP because they were going through their second industrial revolution after the Mao Zedong the Cultural Revolution. They went through so when America started their second great revolution, which to put in simplicity for everyone, the second industrial revolution was basically the great rotation from rural economy to urban. Right. And we saw that in China, rapid. So as America went through their rural to urban advancement rotation, in about 120 years, China sped through theirs. Exactly, 20 to 30 years after Mao was out, and his successor, the one who kind of put China on its, at more capital. I mean, they can say they're communists, but they're more capitalist in spirit. But so that has fueled growth. Their the glut of money from the Western world that was looking for yield flowed into the emerging markets. And but sorry, before I continue that, so in the 1960s to 70s, and so the Treasury had promised a certain amount of entitlements, but the problem is diminishing returns happened and growth started sinking. And that put the US government in a pickle. Well, actually, all major economies in a pickle, because when you have growth declining, but your entitlements and like promises that the government made to their people increasing, how are you going to afford it? Well, Fed steps in. Hey, okay, if incomes aren't going to increase because of growth, let's cut interest rates so that debt can become cheaper so it can supplement the lost income. And that's effectively what we've seen since the 1980s. We've seen the hyper-financialization of the US economy. And I really recommend Krippner's book showing how that economy has taken place. Because, if, for instance, to people who want to understand financialism.
Do you get that title, Professor Volge? I know you're auditing the class. Okay. All right,
great.
Ahead,
It's a great book. You know, it can be a dull read for most, but it's highly recommended. You know, most
Not
of this
for
work can be
Steve.
dull because it's important. Oh, great. I'm glad someone else does too. But
you two are the only guys.
Right? I mean, it's dull, but it's very important because a lot of people, they assume just that, you know, oh, the Fed just started forcing rates lower to, you know, because XYZ of Reagan or Volcker or whatever, but they don't look at the causal relation that the government was effectively broke almost at that point. I mean, they not in debt, but that they saw that the people and everybody incomes were diminishing. So when you have incomes diminishing, you have to make credit cheaper. It's like, okay, let's supplement those loss of wages. You know, if people are losing 5%, then they can use their credit card or et cetera. But the problem is, as leverage increases, demand for money erodes, and which, like as we saw with Irving Fisher, with debt deflation. And that's what we're seeing in the economy since the 1980s. There had been very low I call it deflation, Japan deflation, but you know, some call it disinflation. But you saw one of the longest periods. The only other period was the late 1800s when the first gold standard started, with the longest period of sub 2% inflation. And the Fed has been trying tooth and nail to fight that, because in a debtor economy, inflation is what you need. You need to inflate the debt away, right? Otherwise, it becomes a burden, and it creates the debt deflation cycle, because if there's no more demand, then prices turn. And if housing prices or stock prices start turning the other way, and the wealth effect, which is effectively what the Fed has tried to do by creating an asset bubble, because they're like, hey, all right, if we can't make people wealthier and credit cards are maxed out, let's pump their home values up, their home equity up. Let's pump their stock prices up so they can take that Caribbean cruise, or they can go on that extra trip, or they can buy that Xbox or XYZ, whatever they want.
So has the paradigm shifted in your view, Adem?
Well, my opinion is the Fed is just pushing rope. I mean,
pushing on a string. Well, they're trying to tighten. I mean, when they're easing and no response, to me, is what meant pushing on a string.
Exactly.
That means you're trying to stimulate, but it's having no impact. QE.
Exactly.
And QE was losing its impact anyway. But aren't they moving towards more restrictive monetary policy for a while until there's an accident?
So exactly like you say, until there's an accident. So the Fed is going to jawbone, but the thing is, the higher interest rates on the short end of the curve have already kind of done a lot of the work for the Fed. As the economy became more financialized, it meant more reactive. So back in the day, when Greenspan even said, he said, "Oh, we'd cut the Fed funds rate at the very low, very end of the curve, like the bank interchange rates, and then over time it would trickle into the long end of the curve." But in the late 90s, he was even shocked at how Fed rate cuts or hikes at the short end would more or less influence the long end of the curve immediately. And that's what we're seeing today. So by interest rates, short end of the curve, even the 10-year going up recently has kind of done a lot of the work for the Fed. So even if they hike today, what is it going to do? We've already seen interest rates increasing.
We've gone from 50 bips to 180 in the 10-year.
Exactly. Yeah, and that
tripled.
effectively in itself is a tightening. That's what I'm saying. A lot of people, same with the reverse repo. These are soft forms of tightening already, and so if the Fed, so I've seen a lot of people push back, say, oh, this just means money markets and the banking institutions have 1.6 trillion in gas powder that they can spend. But that's the problem. If they weren't spending it in 2021 when the economy was booming, and now we're seeing that growth fade because of mean reversion, what do they expect in 2022? So my forecast, like you and I spoke last time, is 2022 is going to be a year of slower growth, probably lower rates on the longer end of the curve. We've seen that QE is deflationary in the long run because it sucks collateral out of the system. And for, like we were talking about earlier, banks want yield. The rich want yield. They can't put their money under a mattress. They need to find somewhere. Insurance companies, they need somewhere to turn that zero yielding asset. Even if there's 2% inflation, that cash to them is toxic. Well, China's running a surplus. The Eurozone are running surpluses. So we're seeing investors in those countries look elsewhere. To put that in perspective, Germany in 2020, I believe, ran the largest surplus in the world. Now China is doing it again. China's current account surpluses have been declining for years, but now they're back up, and it makes sense. They want growth, they want money, so they're trying to export their excess abroad. But when one country runs a current account surplus, that equivalently means somebody else is running a deficit. And America, for the last 40 years, has been kind of that absorbing barrier for the rest of the world to get growth. So China, so the Eurozone, for example, they're running QE, but the Eurozone runs a surplus in general because they adopted Germany's fiscal responsibility, more tighter approach after 2012.
Yeah, but Adem, that has started clearly fading away as an intention. I mean, in essence, removal. Yeah. Supposedly he quit for personal reasons of Weidmann, and the loosening of fiscal limits, I think, is showing that the Eurozone wants to move away from that approach, at least somewhat. I don't know if you agree.
I do agree with you. I mean, Germany is the main driver of that. The rest of the Eurozone doesn't want surpluses. Obviously, we saw Greece and Spain, they can't afford it. They have double-digit unemployment for the last 10 years. It's not in their best interest to have that kind of economy. So Germany is forcing it on them. So we'll have to see what that changes. But as theirs have declined, we've seen China's increase. China's current account surplus hit, I think, like the decade high in this last year. So they're trying to export their gluts abroad, and it's forcing America to absorb the debt. And the important thing, and like you said, Steve, the important thing is in the time as this is happening, investors in those countries. So if your country is running a surplus, you're not issuing debt, correct? Like America is the big debtor because they're constantly issuing debt, which creditors want. So Germany and the Eurozone aren't issuing new bonds as much as before because of these surpluses. At the same time, the European Central Bank, the ECB, is running their QE, which is sucking whatever few bonds are left out of the economy. That's why we've seen a huge rotation from like Belgium and European investors in the last few years rotate.
But Adem, if there's been this type of demand for the bonds, we've had a pretty big break in the bond market all the way down. And so, are you a believer that we should be looking for spots to buy the long end of the curve here in this environment?
Yeah. So in actually, as irony is, last year I thought bond yields topped out at 1.8 in April, I believe, and I, wrote to my investors and everything, just my blog.
Yeah, I'm just wondering how you're going to deploy assets in this environment that you're describing, and I'm not clear as to whether or not you think we're headed towards another deflationary period, or we've been in one, or if the Fed has a shot at taming, which I think, embedded inflation. I don't think soybeans or wheat or copper, maybe copper, but agricultural commodities don't care about higher interest rates.
You're absolutely right, and
Weather.
I think that's the problem with how skewed and bastardized the idea of inflation has gotten over the last 40 years. Because there's three types of inflation: you have demand side, supply side, and monetary side. Monetary side basically is gasoline on the other two and makes it more volatile. But demand and supply side are the most important. So
Yeah.
if demand doubled overnight, you would see, and supply stayed stagnant, prices would double. If supply, like we saw in the oil embargoes, got cut 50%, you'd see prices double, more or less, right? So the thing is, so we've seen the supply issues happen, especially in the used car market and in the
everywhere.
US. Exactly. And it's played, but in my opinion, this is temporary because higher prices lead to excess supply, and which we're going to see companies start pumping out. I mean, that's been the trend for 40 years. I mean, the globalization equivalently meant gluts. It meant, hey, any country can export their surplus abroad. Back in the day, you couldn't do that. How could you keep the meat before there was air conditioned freighters?
But isn't the whole supply chain thing something that's going to take years to resolve? We have the just-in-time inventory to never-in-time inventory to having unreliable suppliers, as China tries to pull away as much as possible from the U.S. So how's that until we bring manufacturing back to the U.S.? That's going to be a long-term process, isn't it, to relieve the supply chain?
You're right. It could be. I'm actually I was impressed with how resilient the supply chain has been, except for like the semiconductor market and the car market during the COVID period. I was really impressed with how, like, hey, even during a pandemic, the economy was able to adapt and we didn't see higher inflation. I mean, I would go to my supermarket at the beginning and there would be no toilet paper. And in free market ideology, especially in America, I think there's an oligopoly in the meat market. The top two firms control like 90% of the meat company. And that's a whole nother issue, is corporate concentration, which I hope we can talk about one day separately, is how, just there's been a total consolidation over the last 40 years, sprung between a very lax antitrust enforcement, meaning completely just mute. They're not even trying at this point to stop. I mean, we just saw the other day, Microsoft bought Activision Blizzard, one of the biggest gaming companies. That comes months after they bought Bethesda. So effectively, Microsoft now controls 30% of the intellectual property of the gaming industry. And I posted it on Twitter, and a lot of people were like, "Oh, but who cares? Those companies make crap games anyway." And I'm like, "But that's the point. When you have fewer companies, the quality declines, and we're seeing gaming prices go higher, and we're seeing that across 80% of the industries. The top four airplane companies control, almost 90% of the entire market. The top six banks control.
Speaking of which, do you think that this buyout is actually going to go through?
The antitrust department, I think the last time they even really did anything great was when Whole Foods tried to buy Wild Oats chain back in the early 2000s, and at first it went through, but then they kind of had Whole Foods divest Wild Oats because they said they found out that they were going to raise prices. Well, every time a big merger like this happens, they raise prices. So I wouldn't be surprised if it goes through, because as we've seen, let me just find the chart of antitrust enforcement.
And before we wrap here, Adem, I'm interested in how you're deploying capital and what kind of bets you're making for 2022.
So 2022.
Do you want to share that?
So I think 2022 is going to be a year of Fed policy error. Not that I don't think they should hike.
So are you buying long-term put options on rallies now in the market?
Yes, actually. So I had been, I actually got lucky in November. I wrote to subscribers that I was short Germany. I said, hey, I think the German economy is has worse days ahead as the tide turns. And the thing I love about optionality is that it didn't even matter if I was right or wrong. Let's say I was totally wrong, but now with Russia, the whole Russia crisis with Ukraine spreading fear, or Fed tightening in Germany has caused their asset prices to plunge. And all of a sudden my put options are up 500%. So that's why I love optionality. I think it's so important. You can lock in something today. It's like insurance. It's like you lock in a position or a gamble, and something that I never even thought would happen, Ukraine, Germany, or whatever with Russia causes a crisis. Great call. Nice. Yeah, and so I think so. Sorry for 2020.
So you stay with this. It's it continues to unfold.
Yes. Yeah.
There are rallies, but do you believe this is a shift from buy the dip to sell the rip?
So I think that as the Fed continues their hawkish momentum or stance, and the market has priced it in, as we talked about earlier, they already lifted interest rates basically for the Fed at this point. The thing is, I think the market, or a lot of investors don't realize that there's lag effects. Markets are reflexive cycles. We'll see it. A boom will be self-fulfilling. It will carry itself higher. And conversely, once it starts turning from the top, it will pull itself lower. And we see these big volatile swings. And the more money is printed, it's like we said earlier, there's gasoline on top of it. So the booms get bigger and the busts get bigger. And as more of we see,
is there a chance for the dollar to shift into a bear market mode? I know you've been constructive for a while.
I don't think so, because like you and I have talked about in the past, for someone to sell, so effectively that means investors or whatever banks, institutions would effectively have to sell their currencies. No, I'm sorry. They would have to sell dollars to buy another currency. Well, what would they buy at this point? What would you want over the dollar? I mean, it controls 60% of SWIFT. Almost all payments are still in dollars. Bond market in America, investors are begging America to run deficits at this point to finance it because they want yield. I don't see how we would see the dollar really fall back to lows like we saw after 2008 when we saw the gold bubble pick up. And I'm a big fan of gold. I mean, 2016 to 18, I was lapping up gold. I mean, now it's a different ballgame. Back then it was 1,100, 1,200 an ounce. Now it's 18, almost 1,900 an ounce. And a lot of that's to do with inflation. But I think as we see emerging markets and other firms have to liquidate to pay their debt, unless somehow there's some big jubilee where debt is forgiven, that I don't know how they're going to finance it. We're going to see debt being dumped on the market, which we saw in third quarter 2021, if I remember right. We saw Turkey dump a lot of their gold on the market to raise cash. And
maybe Putin's going to have to sell some gold to fund his adventurism.
Yeah, no, you're totally right. So I wouldn't be surprised. Like, I like gold. And to me, gold is insurance, whereas gold mining companies and et cetera are, for wealth creation. It's like speculative, whereas one is, hey, if the dollar goes to hell, I can take this gold ounce, go to Japan or whatever country, and I can convert it into XYZ, and it will never have a non-value.
Well, at that point, they're not going to let you leave, and they're going to take your coin.
You're totally right. At that point, I mean,
so anyway, I'm just saying, man. It's nice to be Walter Mitty and think that we could all just. I don't.
You're right. You're right. At that point, the government.
I think it's already. We're already locked in, man.
No, anyway, you're right.
You another great interview by an insightful and really passionate young economist. You are, and a better. Very good speculator. Next time you have those that kind of call, ping me and let me know what you're thinking.
So, and Steve, thanks for and everybody for chiming in.
Thank you, mate.
Adem could be he could be your mentee, or maybe he could be your mentor.
I could learn a lot from Steve. I appreciate it.
Anyway, I'm just trying to put together a little bromance here.
Well, I appreciate it, and I respect the work you guys do and everything. And like you said, it's all subjective. We're all just sitting here trying to navigate the world. We get lucky, we don't get lucky, but the more knowledge we have, hopefully we can make better decisions. And
amen, amen to wisdom. Exactly. So thank you for sharing yours today, Adem.
Yeah, thanks for having me, guys. I always
was,
appreciate
really-
it. It's always an honor.
I'll get you. We'll talk or exchange messages a little later and keep you going in the rotation. Okay.
Have a
Okay,
great
sounds
day.
good, sir. Have a good day,
All right.
guys. Thank you.
Adem,
Bye-bye.
you could join the team in 13 minutes on the morning edge. And guys, yeah, even Adem, you ought to subscribe to us for some of your trading timing. Maybe we could help you. I'll talk to you guys later. Everyone, take it easy. Don't just count your pips, count your blessings. Can you believe I almost forgot that today? Steve, can you believe that? I'm really off. I'm off center.
You're
Okay.
excused.
All right. See you guys.
Bye-bye.
Hey traders, this is Blake Morrow with ForexAnalytix. Thanks for stopping by our YouTube channel. Don't forget to like these videos, share them, and subscribe to our channel so you don't miss any of the content that we provide here for free. Thanks for stopping by. I'll see you in the next video.